Understanding credit, how to boost your credit score. Your credit score is a critical element of your financial health, and it can impact everything from your ability to get loans to the interest rates you pay on mortgages, credit cards, and auto loans. Understanding credit and how to improve your credit score can be one of the most important steps you take toward building a solid financial future. In this video, we'll break down how credit works, why your credit score matters, and provide practical steps on how you can boost it. What is credit? Credit is essentially a financial arrangement where you borrow money or access goods and services now with a promise to pay it back later. When you use credit, you are utilizing the trust that lenders place in you to repay what you owe. There are different forms of credit, including credit cards, mortgages, auto loans, and personal loans. The terms and conditions of these credit arrangements, such as the repayment period, interest rate, and amount of credit extended, can vary depending on the type of credit and the lender. Credit is a tool that can help you achieve financial goals, such as purchasing a home or starting a business, but it comes with a responsibility. If you manage credit poorly by missing payments or accumulating too much debt, it can negatively impact your financial life. On the other hand, when you manage your credit well by making timely payments and borrowing responsibly, it can open doors to lower interest rates, better loan terms, and higher credit limits. The importance of credit scores. A credit score is a numerical representation of your creditworthiness, or the likelihood that you will repay borrowed money on time. The score is calculated based on your credit history and how well you've managed credit in the past. Credit scores are typically calculated by three major credit bureaus: Equifax, TransUnion, and Experian. They use proprietary algorithms to assess your credit report and generate your score, which typically falls within a range of 300 to 850. The higher your credit score, the more attractive you are to lenders. A higher score indicates that you are a reliable borrower, which can result in lower interest rates, larger loan amounts, and better terms. On the other hand, a lower credit score can make it more difficult to get approved for loans, and if you do qualify, you may face higher interest rates. Here's a breakdown of the common credit score ranges. 300 to 579, poor credit. 580 to 669, fair credit. 670 to 739, good credit. 740 to 799, very good credit. 800 and above, excellent credit. Understanding your credit score and how it is determined is the first step in improving it. The factors that affect your credit score. Your credit score is calculated based on several factors, each weighted differently. The exact formula for calculating your score may vary slightly depending on the credit scoring model, but here are the 5 main components that determine your credit score. Payment history, 35%. This is the most important factor in determining your credit score. It reflects whether you've made payments on time and in full for all of your credit accounts, such as credit cards, loans, and mortgages. Missing payments, making late payments, or having accounts sent to collections will negatively impact your score. On the other hand, a long history of on-time payments can significantly improve your score. Credit utilization, 30%. Credit utilization refers to the amount of your available credit that you are using. It is calculated by dividing your total credit card balances by your total credit limits. A higher credit utilization rate, using a large percentage of your available credit, can indicate to lenders that you may be overextended and may struggle to repay borrowed money. Ideally, you should keep your credit utilization ratio below 30%. For example, if you have a $10,000 credit limit, try not to carry a balance higher than $3,000. Length of credit history, 15%. The length of time you've been using credit also plays a role in your score. Generally, the longer your credit history, the better it is for your score. A longer credit history provides more data on your spending and repayment habits, allowing lenders to gauge your ability to manage credit effectively. To boost this factor, avoid closing old credit accounts, even if you don't use them regularly. Credit mix, 10%. Having a diverse mix of credit types can help your credit score. This includes a combination of credit cards, installment loans, auto loans or mortgages, and retail accounts. A well-rounded credit mix demonstrates that you can handle various types of credit responsibly. However, you should only take on new credit if it makes sense for your financial situation. Opening too many accounts in a short period of time can hurt your score. New credit, 10%. Each time you apply for new credit, a hard inquiry is made on your credit report, which can slightly lower your score. Multiple credit inquiries in a short period can be a red flag to lenders, indicating that you may be taking on too much debt. To avoid negatively affecting your score, only apply for credit when necessary and try to space out your applications over time. How to boost your credit score? Now that you understand the factors affecting your credit score, let's explore how you can improve it. Building or improving your credit score takes time, but with consistency and responsible financial habits, you can raise your score over time. 1. Pay your bills on time. The most important step you can take to improve your credit score is to pay your bills on time, every time. Late payments can stay on your credit report for up to 7 years, and they can significantly lower your score. Set up automatic payments for bills that allow it, or use calendar reminders to ensure that you never miss a payment. If you're behind on payments, get caught up as soon as possible to stop any further damage to your credit. 2. Keep your credit utilization low. One of the easiest ways to improve your credit score is to keep your credit utilization ratio low. Aim to use no more than 30% of your available credit at any given time. If your balances are too high, try paying them down. You can also ask for a credit limit increase to improve your utilization ratio. But remember, if your limit increases, it's important not to increase your spending habits as well. 3. Check your credit report regularly. Errors on your credit report can drag your score down. That's why it's important to check your credit report at least once a year. Under the Fair Credit Reporting Act, you are entitled to one free credit report per year from each of the 3 major credit bureaus. Review your report for any inaccuracies or fraudulent accounts and dispute any errors you find. Correcting mistakes on your report can lead to an increase in your score. 4. Avoid opening too many new accounts. When you open a new credit account, it can temporarily lower your score due to the hard inquiry. Avoid applying for multiple new credit cards or loans in a short period of time. Opening too many accounts can also lower the average age of your credit history, which can further hurt your score. Only apply for credit when you truly need it. 5. Pay down existing debt. If you have multiple credit card balances or loans, focusing on paying down your debt can improve your credit score. Consider using the debt snowball method, where you pay off the smallest debts first, or the debt avalanche method, where you pay off the highest interest debt first. As you reduce your debt, your credit utilization will decrease, and your score will rise. 6. Keep older accounts open. The length of your credit history makes up 15% of your credit score, so closing old accounts can hurt your score. Even if you don't use an account regularly, keep it open to lengthen your credit history. If you have old credit cards with no annual fees, keeping them open can be beneficial. 7. Consolidate debt. If you have high-interest debt, consolidating it with a personal loan or balance transfer credit card may help reduce your interest payments. This could help you pay down your balances more quickly, improving your credit utilization and overall score. 8. Consider becoming an authorized user. If you have a family member or friend with good credit, you might consider asking to become an authorized user on their credit card account. This allows you to benefit from their positive credit history without being responsible for making payments. However, make sure the primary cardholder has a solid payment history to avoid any negative impact on your credit score. Your credit score is one of the most important aspects of your financial life, affecting everything from loan approval to interest rates. By understanding how credit works and taking steps to improve your credit score, you can unlock better financial opportunities and lower your borrowing costs. Improving your score doesn't happen overnight, but by paying your bills on time, keeping your credit utilization low, and practicing responsible credit habits, you can build and maintain a strong credit profile. Start taking control of your credit today, and with patience and persistence, you'll see your score grow, giving you greater financial freedom and opportunities for years to come. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.